with Gurmeet, but given what the market is doing, if I could squeeze in that question first. Gurmeet, first of all, season's greetings to you, and good to have you today and at such times. And what a phenomenal rally it's been. It's been a great 2023. And the commentary that we're picking up from a lot of, international participants or chartists. Today we're speaking to Atul Suri. The belief seems to be that this is going to last. Are you in that camp as well?
Hi, Surabhi, and season's greetings. I think this Santa rally has been without a clause. There was some hiccup in between, when we saw some correction, and that's the nature of the game. I think the risk only goes up when you think everything is fine, right? And when all macros look good, whether it is oil, we had a current account deficit numbers, all high frequency indicators indicating economies on a good track. Is when probably the unknown thing strikes. And I think, I have no concern as far as, the medium term, long term story goes. But there are a few pockets one has to be careful. With every sharp rise, in the market, the risk is actually going up. We think on the otherwise. So I think there are pockets in small micro caps, there are pockets in IPOs where there is exuberance and some correction is due. It may also happen, market may completely make you look foolish, which it always does. And it may happen after Nifty goes up another 400 points and come back to maybe back at 21. But you just got to be careful with asset allocation. I think it's just that incremental money needs more diligence, in my view. And I've been maintaining this, Surabhi. I think bond portfolio also offers good risk reward. A 50-100 basis point softening in yield will lead to 5, 6, 7% mark-to-market gains in bond portfolio also, other than the coupon being 7. So I think just balance it a little bit and maybe a little more biased towards large caps right now.
It's double dhamaka, double bonanza, right? It's not just stocks, but even bonds perhaps so will start making you money now as we get into the new year. Gurmeet, just another follow-up question on the market. Like you said, that it's important to keep all your risk assessment measures in place. What the market is also doing is that despite all the disbelief, it's the same set of stocks that keep going higher and higher. Your Mazgaon Dock, your BEL, your industrials and CapEx. And then therefore, for those who are trying to play contrarian or going back to an HDFC bank or trying to think of, or Asian Paints for that matter, those themes are not working. So for fresh money allocation, you feel nervous. Should you allocate to a stock that's already run up 200%, or should you sort of look out for things that have not run? What would you do as we start the new year?
So as I said, I think a little contrarian would help. I think banks continue to give good risk reward. SGFC, ICICI, SBI, I think all leading banks offer you good risk reward. So SBI, for example, is 1.2 times book, 9 times earnings. You have... Sorry. I lost you in between. So, and then, mid-small cap pockets in banks are showing exuberance. I think IT could be a good contrarian bet for next year, but you probably have to wait it out for maybe 3-4 months. Pharma, in my view, is offering good risk reward, especially the CDMO names and the diagnostics names. They are probably due. I also think the agri budget will get a significant leg up as we enter the election year. And that one pocket which hasn't done well. So, agrochemicals, farm equipments, and more FMCG, which have rural presence, which have been slightly underperformers, could do well. So I think I agree with you. Some part of the portfolio could be in agrochemicals, some bit in IT, some bit in pharma and agri theme. And I think the exuberance part, which I said, so like, for example, railway or defense, the order book is probably pricing in next 6-7 years. Good news, right? So a lot of the good news is upfronted in the price. You will not get to know now. It will happen once, the time and the price correction starts. So that pocket, I think you've got to be very, very selective. In fact, a lot of that pocket is best avoidable right now in terms of incremental allocation.
Gurmeet, do stay on. We need to slip into a very short break. And on the other side, as promised, we'll talk about the Ola Electric IPO and the DRHP, which was recently filed. So we'll analyze it in greater detail with Gurmeet.
CNBC-TV18, embarking on a quarter century of excellence. CNBC TV18, embarking on a quarter century of excellence.
Okay, welcome back. Absolutely sort of, back at, it's like it's an all-time high, of course. And if you're just joining us, it's 21,593, which was the last high that has been taken out. And we were discussing that with Surabhi, Reema. Gurmeet, of course, is still with us. But there's another way to call it. It's a 4-day high, right? Because, I mean, the previous high was made on Wednesday when the market fell unexpectedly, middle of last week, if you remember. We opened the high point of the day, which is 21,593, traded strong with a 200-point gain. And then starting about 1:30 that afternoon, there was that severe fall. So there was a very large candle on the way down, which was formed. And 4 days since, I mean, today is the 4th day, with a holiday in between, which is Monday, we are back at new all-time highs for the market once again. So can't keep, indices in a bull market down. The trend has been up. And it's looking very, very good. Gurmeet is still with us. Gurmeet, thanks for staying with us. No doubt, I mean, the trend is up and it's a bull market and everything. I just wanted you to comment on the very near term, the end of the year kind of phenomenon, right? There are two ways to look at it. One is to say, I mean, we've spoken about this over the years, end of the year, volumes thin out, etc. So price moves are exaggerated. Foreigners are absent. So with little effort, you can do a lot as far as the price is concerned. I don't think there are reasons to do a lot because it's looking good out there. But just your thoughts, end of the year phenomenon.
I think you're right. I think low volumes can exaggerate movement, Prashant. But this is, a very, very strong uptrend. And, a lot of us have been advising clients that, few pockets are looking expensive. But the market, as I said, keeps humbling you. And that's why I say that, if you miss 10 best days in the year, your returns are gone by almost 60-70%, which is what market has done since November, right? You miss the 10-12 best days and the returns could be suboptimal. But as I said, a lot of pockets require, there's no harm in taking some money off the table on, let's say, railway capex names or defense names. A lot of IPOs, if you've made handsome listing gains, especially in the small micro cap. I think what happens is reducing float, growing flows, can make a bubble out there. And that's the place you have to be watchful for. Broader Nifty, I agree with you. There could be some more legs. I think a lot of them, half of the market probably needs a bit of a catch-up, the like of HDFC, Reliance, some of the IT names as results come in January. I think that could be if IT delivers good numbers in Jan, I think market can deliver a little more in the short term.
There is also serious, obviously, FOMO factor, right? I remember last week we were discussing on the show, somebody I was talking to, a PMS fund manager who got a commitment from a family office. And, the plan when the money came in was to deploy it in a STP way, systematically, over a period of 3, 4, 5 months. And then, the fund manager told me that after I think it was the state election results, Monday we got that big rally. By Tuesday, he got a phone call and said that, well, put everything in. Don't. So from 4-5 months, it became all in immediately. It proved out to be a good decision, but that FOMO feeling is also very strong, and it's not confined to the lay investor. Professionals out there also a victim of that.
Oh, absolutely, Prashant. In fact, a lot of fund managers are stopping flows. Fearing some. You see, most small mid-cap funds have restricted flows. So there is that FOMO there. But as I said, the risk is actually going up if you are deploying. And sometimes you may look, staying out of the market. I have clients who were more waiting for 17,000. Now they will be happily putting money at 20,000. That's what happens. When it keeps making highs, your goalpost also keeps changing. But as I said, market will keep giving opportunities. Rotation is a better thing to do. Some small profit taking in few exuberant pockets may not be a bad idea.
While we're having this conversation on the market, Gurmeet, allow me to come back to that one little point of concern that you raised. And you spoke about recent IPOs. And nowadays we have like 3 listings a day. We're in that kind of a phase, right? So just tell us, if there are some names where you would be personally cautious, if you want to flag off, any of the companies where you think perhaps the numbers are not adding.
Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.